To understand better, let us quickly work out a short exercise. A Limited occasionally sells goods on sale or return basis. It records such deliveries as sale in its daybook. On 20th March, it sent goods costing rupees 1 lakh at a profit of 50%. Costing 1 lakh at a profit of 50% on cost to one of its customers, XYZ Limited. These goods needed to be approved or returned by 20th April. On 25th April, 60% of these goods were approved, while 10% were returned, and for the balance, no intimation received. Past journal entries for these transactions assuming A Limited closes its books of account on 31st March. So we have a goods being sent on approval on 20th March. We have goods being returned on 25th March. We have goods being approved on the same date. And we have goods which are lying with the customer as at 31st March. Let us pass the entries chronologically one by one. First entry on 20th March when goods are sent on approval. We will record it as an ordinary sale transaction. Therefore, the debtor is A Limited. A Limited debit to sales. What would be the value? Let me put some working notes here. When cost is 1 lakh, profit is 50%. 50% of 1,50,000. Therefore, the total sale value would be 1,50,000. A Limited to sales 1,50,000. Next, on 25th March, 60% of these goods are approved. When goods are approved, we do not pass any entry since the sales transaction has been passed. So, no entry for the goods which are approved. No entry here. 10% of the goods are returned. What is the entry for return? It would be sale return account debit to the debtor A Limited. What is the value of these goods? 10% is being returned. 10% of the sale value of 1,50,000, we are talking of 15,000. So, goods sent on approval, we have passed an entry. Goods returned, we have passed an entry. Goods approved, we need not pass an entry. As on the date of closing, we still have 30% of the goods which are lying with the customer, which have not been returned, have not been approved. These goods belong to us. This is not to be considered as sale. So, let us first cancel the sale transaction. That would be sales account debit to A Limited. And what would be the value? It would be 30% of 1,50,000. That would be 45,000. We would also have to bring this stock into our books, and the entry for that would be stock with customer on sale or return to closing stock. What would be the value? Value would be the cost or realizable value, whichever is lower. Since we have sold at a profit, we would consider this value at cost. What would be the value? It would be 30% of the original cost of 1 lakh. This would be the scheme of entries as at 31st March. It may be noted that in the next year, If the customer approves of these goods, we need to pass a new entry for sales. However, if the customer returns the goods in the next year, we need not pass any entry. I'll repeat that once more. In the next year, in the coming year, if the customer approves of these goods, we need to pass a sale transaction because we have cancelled the sale transaction with respect to the goods which are lying with the customer, not approved, not returned. However, if the customer returns these goods, we need not pass any entry. We need not pass any entry.